Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Paysafe stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or sell. Paysafe is an online payments company. It operates in over 40 countries. You could think of this company as PayPal that also accepts cryptocurrency. It owns Neteller, Skrill, and Paysafe Card, plus a lot of other brands. Neteller is a digital wallet that allows consumers to add, withdraw, and transfer funds to and from merchants and other people. Skrill is a product that allows payments and money transfers to be made through the internet with a focus on low-cost international money transfers. Paysafe Card is a way for customers to make online payments without a bank or credit card. It leads all companies in iGaming transactions. This company processes 100% of the poker, casino, sports betting, and iLottery in Canada. It's also active in 15 US states. The total addressable market for iGaming is $80 billion. Travel and entertainment is $1.5 trillion. Digital goods is $500 billion. Fintech is $2.9 trillion. And integrated payments is $2.2 trillion. I personally use PayPal and Venmo, but as you can see, there's a lot of opportunity for other companies in this market. It acquired Pago, Efectivo, and SafetyPay to gain exposure in Latin America. Paysafe was funded by a SPAC, a special purpose acquisition company. That's formed to raise money through an IPO, then acquires an active business. At the time of their IPOs, SPAC have no existing operating business, or even a company they plan to acquire. SPACs have 2 years to complete an acquisition, or they must return their funds to investors. Foley Trasimene Acquisition 2 Corp. was the name of the SPAC that acquired Paysafe at the end of March of this year. Bill Foley is running the SPAC, and he said back in March that he wants Paysafe to become the iGaming leader in North America. At one point, the SPAC had a market cap of $14 billion at its peak. It is currently trading at $6.1 billion. Clearly, the stock has struggled since the merger. The stock is trading lower now than when there was no target company identified. The company is headquartered in Bermuda and was founded in '96. It started trading this year and can be found on the New York Stock Exchange. Let's get started with the model. This is a mid-cap company, 6.1 billion market cap. They're trading at $8.46 a share, and they have 724 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow each year except in 2018. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative each year. Revenue is the sales for the company, and that grew in 2019, then it's pretty steady after that. Most SPACs that we looked at don't have previous financial information, because a company doesn't have to provide their financial information if they're private, only when they're public. But this company looks like it provided a lot of its previous financials. That creates transparency and trust with investors. Their numbers are okay, but their revenue is flat, which is pretty surprising because you think in 2020 they would have much higher revenue than 2019, because during COVID, a lot of people were online playing different games like poker and casino games. Also, people weren't going to banks as much, because less people were leaving their house, so it should have gave this company an opportunity to get more customers, but it doesn't seem that way. This is the company's income statement. The top line is the revenue, the sales. So like I said earlier, their revenue is pretty flat from 2019 on. So it's really hard to compete with a company like PayPal. They've been around since 1998. And look at their revenue, $24 billion. Of course, it's a lot higher than this company, but you would expect this company's revenue to grow as a percentage a lot more than PayPal. Of course, dollar-wise, PayPal will grow more, but percentage-wise, since Paysafe's revenue is so small, it should be a lot easier for them to grow 10-20%. But that's not the case. PayPal is growing a lot more percentage-wise and dollar amount-wise. The company breaks down their revenue into 3 segments: integrated processing, digital wallet, and eCash solutions. Integrated processing is about half their revenue. That's the sale of services to merchants that accept Visa cards and MasterCards. A digital wallet stores payment information, so it's like using a digital credit card. They have 3.5 million users on their digital wallets. Neteller and Skrill are examples of digital wallets. They have 13 million users in eCash. That allows people to pay with cash instead of using their credit card or bank accounts. because some people don't feel comfortable using their credit cards and bank accounts. And of course, there's people who don't have credit cards and bank accounts. So eCash is an ideal solution. Below revenue is the cost of revenue. These are the expenses that are directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in 2019. It's a little lower in the trailing 12 months. Then below that is operating expenses, and their main operating expenses, selling, general, and administrative expenses. This is mostly payroll for their employees, and they have a good amount in depreciation and amortization. And then below that is their operating income, which is the lowest in the trailing 12 months. So that is concerning, but I think they're investing a lot back into their business, trying to grow it since they recently IPO'd. This is something you want to keep track of. If their operating income goes down or becomes negative, that could be a big red flag. But if it's low for a year or two, it's no big deal, as long as it rebounds at some point. Then below that is the interest they pay in their debt, which is more than their operating income, so they do have negative net income every year. They also pass through a lot of impairments and restructuring costs. This is due to all the acquisitions and assets they've acquired. So that brought down their net income even more. This is their statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see it's a really good sign that they are generating positive operating cash flow pretty much every year, except in 2018. Because that's the hard part about looking at the income statement. There's a lot of non-cash items that can pass through and bring down your net income. Statement of cash flows kind of cleans that up. And you can see they spend about $100 million a year in CapEx, $87 million in 2020. So in 2020, $5.4 million was investments in property, plant, and equipment. $21 million was from merchant portfolios, and $60 million was from other intangible assets. So I would say they have $5.4 million in CapEx, because these two line items were from acquisitions. So they do belong in a cash flow from investing section, but I don't think all these would be considered CapEx, except for purchase of property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow, and they do have positive free cash flow each year, except in 2018. They issued a lot of stock in 2018, $2.2 billion, and added over $1 billion of debt. It looks like they're starting to pay down debt. They paid down about $1.4 billion of debt in the trailing 12 months. This is the equity section of their balance sheet, and they have $2.6 billion of equity. They raised $2.9 billion from issuing stock, and they lost $320 million from running their business. Let's look at the capital structure. $2.6 billion of equity, $2.2 billion of debt. They're 55% equity, 45% debt. And their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 9.4%. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $5.1 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $4.7 billion. We divide that by 724 million shares. And we get a calculated stock price of $6.44. They're trading at $8.46, so they're trading at a 31% premium. It's a sell according to the model. I have 4 DCF models in my Excel file. I used a model that would give them the highest valuation. And even that model comes out with a value lower than they're trading at. Simply Wall Street values a stock at $14 a share. They're saying it's 39% undervalued. 7 analysts priced this stock, and the average price target was $14. So everybody's saying the stock is undervalued except me. This is where the stock has been trading since last year. So when it was a SPAC, it was pretty flat. And then when they announced they were going to acquire this company, then the stock price really got shot up to around $18, $19. And then when a stock price goes up a lot, there's usually a sell-off. So you can see it came down quite a bit. And then when it comes down, people start buying it again. So it came back up. Then it took a little longer to come down this time. And at this point, they still didn't close the merger yet. They would actually close the deal at the end of March. So there's more buying, which brought the stock price up. And then when they finally closed the deal, the stock got to a low point. It got pushed up a little bit. It came down a little for a few months, but it was fairly flat. And then when they reported second quarter earnings, although they were better than the second quarter of 2020, they were lower than analysts' expectations. So the stock price came down a lot, as you can see. So the stock is trading lower than it was trading before they even had an acquisition target. Analysts are expecting their earnings to grow 111%. That's a big jump. Their revenue to grow 12%, which is a little less than our industry of 15%. If you invested $10,000 into this company when it started trading, you'd be at $8,400 today. That's a 16% total loss. But you can buy a lot of shares now and dollar cost average to a lower average share price. Of course, you should only do that if you're bullish on this stock. Here's a list of their biggest shareholders. Back in 2015, 3 companies, Pi Holdings, Blackstone, and Canay Holdings, they got together and acquired this company for $4 billion on the London Stock Exchange. That's why they hold so much of this company's stock. Fidelity also owns 6.9%, then Third Point owns 5.7%. Let's look at their financial ratios. We can't look at the PE because they have negative net income. They have a decent price to sales ratio of 4.1. That's between the market median and average. Price to sales is stock price over sales per share. They also have a good price to book. That's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities, and they have $2.6 billion of equity, negative $2.3 billion of tangible equity, since they have $4.9 billion of intangible assets on their balance sheet. So they have so many intangible assets because they acquire a lot of companies. And that's generally what happens when you acquire a company. You get intangible assets on your balance sheet. The way you get intangible assets is if you acquire a company for more than its net assets. They have a low return on invested capital. They can't even cover their interest payments on their operating income. They have a negative ROE since they have negative net income. And their current ratio and quick ratio are fine. They have $247 million of cash on their balance sheet, $300 million of receivables, and $1.2 billion of restricted cash. Restricted cash is cash that's set aside for a specific purpose. They do seem to have enough money to fund their operations for the next 12 months. They generated $186 million of free cash flow in the trailing 12 months. And they have $214 million of working capital, so they have $400 million of funding. Although they may need some debt or equity financing if they want to acquire another business, which is pretty likely. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 15 companies in the same industry as Paysafe. And if Paysafe has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So we can't look at their PE. They are better than average in price to sales and price to book. They have a good current ratio. They have a negative ROE since they have negative net income. They're a little lower in debt than the average company. And they are a pretty small company at $6 billion market cap. The average is $33 billion. And of course, they don't pay a dividend. To summarize, I have them trading at a 31% premium. But I think it's going to be a really hard task to get market share in this sector because there's some really big companies like PayPal that have been around over 20 years. Venmo that's been around over 10 years. There is definitely opportunity, but there's a lot of big players in this space, not to mention all the banks that do something similar. For instance, with Chase, I use Zelle to send payments to people I know that have Chase accounts. But I think if they focus on their niche, which is iGaming, they could become a big company just in that space alone. And of course, when you have clientele, regardless of where you got them from, they're likely to do business with you in other places as well. For instance, if somebody likes online poker and they use this company to transfer money to and from that poker website, they just may get comfortable with Paysafe services and start using them in other places as well. I am bearish on this stock. I do think it will come down more, but there could be a bull run. You never know with this market these days. Anything can happen. I rank their free cash flows 5 out of 10, their revenue 7 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.